Something happened in the global financial system this week that almost nobody is talking about. And I mean nobody. Not CNBC, not Bloomberg, not the mainstream crypto media that would rather argue about Bitcoin ETF flows. While the noise merchants were busy pushing their narratives, the Bank for International Settlements quietly released data confirming that $27 trillion in Nostro and Vostro accounts is sitting paralyzed in correspondent banking networks around the world right now. Trapped, locked up, earning nothing, doing nothing. Just sitting there because the current financial plumbing is so inefficient, banks have no better option. That $27 trillion has a name. It has a destination. And today, I'm going to show you the math that explains exactly why XRP is the only logical answer, and why, when this transition begins, the price you're looking at today will look like a rounding error. Welcome back. If you're new here, I don't do hype. I don't do moonboy price targets. What I do is take the data that the crowd ignores, the structures the institutions are quietly building, and I decode them clearly so that the informed investor understands exactly what is happening and why. Today, we are going deep on the mechanism behind XRP's price, not the speculation, not the chart patterns, the actual structural reason that a high XRP price isn't a wish. It is a system requirement. Let's get into it. Let me start with the hard truth that most XRP holders have heard but not fully internalized. The number one question circulating in this community right now goes something like this. If banks and financial institutions are going to use XRP, doesn't it need to be stable? Doesn't volatility make it impossible for institutions to hold? And that question, that concern, comes from an intelligent place. If a bank holds XRP on its balance sheet and the price drops 30% overnight, that's not a utility cost. That's a catastrophic loss. So the obvious conclusion people land on is XRP needs to be pegged. XRP needs to be artificially stabilized. Some committee somewhere needs to set the price and hold it there. Here's where I need you to stop and think clearly, because that conclusion, while intuitive, is solving a problem that doesn't actually exist in the way people think it does. Here's the mechanism most people are missing. XRP is not designed to sit on a bank's balance sheet the way gold sits in a vault. XRP is not designed to be held. It is designed to be used, and used in milliseconds. Think about what on-demand liquidity actually means. A payment institution in Japan wants to send value to a counterparty in Brazil. In the current system, they need a pre-funded Nostro account in Brazil, loaded with Brazilian reais, sitting idle, waiting. That is dead capital. That is the $27 trillion problem. With ODL, that Japanese institution sends Japanese yen. XRP converts it in real time, and Brazilian reais arrive on the other side. Total transaction time, 3 to 5 seconds. XRP was in the transaction for seconds. It was never sitting on a balance sheet. It was never subject to overnight price risk. The volatility problem people are worried about? It's already been engineered around. And the people who understand this are not retail investors on Twitter. They are the architects at Ripple, at the Bank of Japan, at the financial institutions quietly piloting this system right now. That is the hidden mechanism. That is what the mainstream narrative is missing. Now let's do the math, because this is where it gets genuinely extraordinary. There are 100 billion XRP in existence. Fixed. That number will never change. Of that, approximately 55 to 57 billion are in circulation. The rest is locked in Ripple's escrow and released in tranches, and the majority of what's released gets relocked. That is a hard supply ceiling. Now think about what this system needs to handle. Cross-border payment flows globally are estimated at 150 trillion annually. That is roughly 410 billion every single day moving between countries. The foreign exchange market alone clears 7.5 trillion per day. And that's before we even touch the derivatives layer, which the BIS estimates at somewhere north of 1.2 quadrillion in notional value. Here's where the math becomes undeniable. If XRP captures just 1% of daily cross-border flow as the bridge currency, 1%, that is $4.1 billion in daily transaction volume needing to flow through XRP as liquidity. Now think about what liquidity means in this context. The XRP that bridges a transaction has to be available at the moment of transaction. It has to be there, ready, in sufficient quantity to absorb the trade and complete the conversion without moving the price catastrophically. That is called liquidity depth. Here's the fundamental law of this system. You cannot add more XRP. The only variable you can change to increase liquidity depth is price. Think about that math. If one XRP is worth $2 and you need $4.1 billion in daily liquidity, you need 2.05 billion tokens available and actively cycling through the system every single day. At $20, that drops to 205 million. At $200, 20 million. A higher XRP price means the same global liquidity demand can be satisfied with a fraction of the available supply, creating scarcity, reinforcing the price floor, and demanding even higher prices as volume grows. This is not speculation. This is not a prediction. This is the mathematical design requirement of a fixed supply bridge asset. If you have a problem with these numbers, you don't have a problem with me. You have a problem with basic arithmetic. The price of XRP is not set by retail traders on Coinbase. It is set by the liquidity demands of a global payment infrastructure. And those demands are only going in one direction. Now, some people hear this and say, okay, that's a nice theory. But where's the proof that institutions are actually moving in this direction? Let me give you the signal, not the noise. Ripple recently completed the acquisition of Hidden Road, a prime brokerage firm that clears over $3 trillion in transactions annually and counts some of the world's largest hedge funds and institutional market makers as clients. Ask yourself this brutal question. Does a company in legal trouble, building a product nobody wants, acquire a firm that moves $3 trillion a year? Absolutely not. That is a company that knows exactly what rails the next financial system is running on and is buying the on-ramps. Then look at what's happening at the regulatory level. Japan's Financial Services Agency has effectively greenlit XRP-based payment infrastructure. The Digital Asset Clarity Act, moving through U.S. Congress, is structured in a way that legal analysts say would reclassify XRP in a manner that removes every institutional compliance barrier remaining. And the SEC's posture toward Ripple has shifted in ways that even the most skeptical observers are having trouble dismissing. Brad Garlinghouse didn't say if XRP gets regulatory clarity. He said when. And he said it surrounded by the kind of institutional infrastructure that doesn't get built for hypotheticals. David Schwartz, the chief technology architect of the XRP ledger, has been explicit. The system is designed to function with XRP as a neutral bridge asset, precisely because it is not controlled by any single nation, central bank, or corporation. That neutrality is the feature institutions need. You cannot use the US dollar as a neutral bridge between countries that don't trust US foreign policy. You cannot use the euro or the yuan. You need a neutral asset. XRP is structurally positioned to be that asset. While retail investors are asking whether XRP will survive, Franklin Templeton, Fidelity, and BlackRock are quietly building tokenization infrastructure on public ledgers. The smart money doesn't ask if the transition happens. They are positioning for when. So when does this inflect? What is the actual trigger? Here's my read. The Digital Asset Clarity Act is not a rumor. It is moving. Legal clarity on XRP's classification as a commodity, not a security, removes the final institutional compliance gate. The moment that language is codified, every major custodian, every prime broker, every treasury management desk that has been waiting on the sideline gets a green light to build XRP exposure into their product stack. And here's what happens next. And this is the part most retail investors do not model correctly. It doesn't happen slowly. It doesn't trickle in. When the regulatory switch is flipped, the wait-and-see money becomes all-in money simultaneously. Months of pent-up institutional positioning hits the market at once. And remember, supply is fixed. The only direction the price can go to satisfy that demand is up. On top of that, the XRPL's native automated market maker and tokenization capabilities launched this year create entirely new on-chain liquidity corridors that didn't exist 12 months ago. We are moving into a phase where the XRPL is no longer just a payment rail. It is becoming a programmable financial market. That is not a small development. That is the foundation of the next phase. The fuse is lit. The countdown is not theoretical. Let me talk about supply for a moment, because this is where most people fundamentally miscalculate. Exchange reserves for XRP have been declining. CryptoQuant data shows on-chain XRP reserves on major exchanges are approaching levels not seen since the last major price cycle. Every token that leaves an exchange and moves into institutional cold storage or into active ODL liquidity pools is a token that is functionally removed from retail market supply. Understand what that means. Once a financial institution routes XRP into a live ODL corridor, that token isn't coming back to Binance for a 15% profit. It is working. It is being recycled inside a liquidity system. It is not available to you at today's price. We are transitioning right now, not someday, from a phase of abundance to a phase of structural scarcity. The window where a retail investor can accumulate meaningful XRP positions at current prices exists because the institutional infrastructure isn't fully live yet. When it is live, the math changes. The price required to satisfy liquidity demand changes, and you will not be buying at the price you're looking at today. The question is not whether you believe in XRP. The question is whether you understand what you're sitting on and what it will cost to hold it 12 months from now. I know what some of you are thinking. You've been here. You've heard the thesis. You've watched the price do nothing while Bitcoin made headlines and other tokens pumped and dumped. I get it. Being early feels exactly like being wrong, right up until the moment reality catches up. Here's how I distinguish noise from signal. When I watch retail investors panic sell on low volume because a price target didn't hit by a specific date, I see noise. When I watch Ripple complete a $3 trillion per year institutional brokerage acquisition during regulatory uncertainty, I see signal. When I watch exchange reserves decline while analysts predict further drops, I see signal. When I watch the IMF quietly publish research papers on neutral bridge assets for cross-border settlement, I see signal. The crowd is staring at price. The architects are staring at infrastructure. Those are two completely different games. And right now, if you're in this community, watching this video, understanding this analysis, you are playing the right game. The red candles are not the story. They are the smokescreen. The story is $27 trillion in trapped capital looking for a new pipe. And there is only one pipe being built that can handle it. So let me close with this. XRP becoming high and stable is not a dream. It is not a peg. It is not an arbitrary political decision. It is a mathematical consequence of a fixed supply neutral bridge asset absorbing the liquidity demands of a $150 trillion cross-border payment system that is actively migrating onto programmable rails. Price follows liquidity demand. Liquidity demand follows adoption. Adoption follows infrastructure. And the infrastructure is being built right now by entities that do not make trillion-dollar bets on dreams. You are not early to a trend. You are early to a system redesign. And the difference between those two things is the difference between trading noise and holding the bridge. If this kind of analysis is what you want more of, not hype, not chart patterns, not price targets. Hit subscribe. Comment bridge below if you made it to the end and you understand what we covered today. I want to see who in this community is actually watching the structure. In a market driven by emotion and noise, we thrive on data and composure. Stay patient, stay rational, and as always, we don't wait for the future, we plan for it.